Okay, so now that we've got a little foundation on what accounting is and how we develop the rules and processes for accounting, we're going to look at recording business transactions in Chapter 2. So we're going to explain what accounts are, how they relate to the accounting equation, which we kind of talked about or looked at in Chapter 1. We're going to define debits, credits, and normal account balances, what double entry accounting is, and what do we use T accounts for, and actually record transactions in a journal and post them to a ledger. We'll talk about what those are in this chapter. We'll talk about and prepare a trial balance and how we're going to use it to prepare financial statements and actually prepare the financial statements, how we did in Chapter 1, and use the debt ratio to evaluate business performance. Okay, so let's look at the learning objective 1 and explain accounts as they relate to the accounting equation. So what exactly is an account? So as you'll remember from Chapter 1, we said our accounting equation is assets equals liability plus equity. So each element of our accounting equation has smaller elements within it, and we call those accounts. So in Chapter 1, when we talked about what an asset is, so like cash is an asset, anything of value that we're going to use to generate revenue is an asset. So cash, accounts receivable, equipment, all of those are going to have their own account within assets. So it's the detailed record of all of the increases and decreases that are going to occur in those individual items during this period. So even our liabilities are going to have those individual accounts, and same thing for equity. Okay, so that's where we're going to keep up with all of the detail changes in each of those items. So then what happens is a company is going to have a chart of accounts. This is just going to be a listing of all of the accounts they use in their system, and we call that a chart of accounts. There's no numbers on there as far as balances, but the actual accounts are going to be numbered, and they're going to be grouped by account type. So this, I mean, it depends on the business size. Smaller businesses may not have as many account numbers, and their chart of accounts is going to be smaller, but the larger the company, the more accounts they're going to have, and the more numbers each account is going to have associated with it. So let's look at an example. So this is a chart of accounts. It's an exhibit in your book. You'll see that the assets over here, they start with 100s. Okay, that's typically going to be what we're going to start with for a small business. If it's a larger company, this might be 1,000. Okay. And it might be different based on how many accounts that the company has, but typically assets are going to start with 100s, liabilities 2, equity 3, and then our revenue items are going to be 4 and 5. So revenues are 4 and expenses are 5. Okay, remember this is part of equity. So you'll see that all the different classifications of our accounts are going to be grouped similarly based on what they are associated with, whether they're assets, liabilities, or equity. Okay, or revenue items. So now let's talk about debits, credits, and normal account balances. So in accounting, we use what we call double entry accounting. That means that anytime a transaction takes place, it's always going to have 2 impacts on the accounting equation. So 2 accounts are always going to be affected. Okay, it doesn't necessarily mean that each account affected has to be on the opposite side of the accounting equation. It just means that 2 accounts are going to be affected, whether it's 2 assets, whether it's an asset and a liability, whether it's an asset and equity, just 2 accounts are going to be affected. Okay, so in this example, when Smart Touch bought land, you'll see the land account went up, okay, because we had an asset, but the cash went down. So this affected the same side of the accounting equation, but 2 accounts were affected. Okay, so this means that the way that our accounting equation is going to stay balanced and equal is this double entry approach. Okay. All right. So now what exactly is the T account? So remember how we said that within each element of our accounting equation, we're going to have our own each account listed for each item. So the T account is going to be this ledger, shortened form of the general ledger account. So this would be like cash or accounts receivable, and this is where we keep up with the increases and decreases. Okay, so the T account after the end of the period, it's balanced at the end of each period, and that's the ending balance for that account. So in the T account, the left side of the T account is always going to be a debit, and the right side is our credit. Okay, and you'll see the shortened form of debit is DR, and the shortened form of credit is CR. Okay, debits and credits, this is what we're going to use to record the decrease and increases in our accounts. Okay, so try not to get, if you've worked in the banking system or look at your bank account information on a regular basis and think of debits and credits that way, try to clear that out of your mind for accounting, and just know debit means the left side of the T account and credit means the right side of the T account, okay? And because of that double entry accounting system, remember, anytime we put a debit in one account, there's going to be a credit in another account that's equal to that, okay? So if an account has more debits than credits, they're going to have a debit balance, okay? If there's more credits than debits, the balance will be a credit. And then we're going to look at some accounts are going to increase with debits and some accounts are going to increase with credits. It depends on what type of account it is. So this little form snapshot here explains the accounting equation and what increases and decreases each type of account. So you'll see here our assets are going to increase with a debit and decrease with a credit. Liabilities increase with a credit, decrease with a debit, and same thing over here for equity. Okay. There is an exception under equity with our withdrawals and expenses, because those things decrease equity. They're actually going to have a balance of a debit and increase with debits. Okay. So let's look at an example. So when they purchase land from that example we looked at, we'll use debits to increase that land. We said land increase, right? So we're going to increase our T account for land with a debit and decrease our cash with a credit. Okay. All right, so here we'll look at owner's capital. So remember we said withdrawals are anything that the owner's going to take out of the company. So they're taking cash out. So this is going to be reflected in their capital balance. All right, so we'll debit the owner's capital. Since it's an equity item, it increases with a credit. So we were going to decrease it with a debit for our withdrawals. Okay. And same thing here. So when revenues exceed our expenses, we have net income. And remember, net income increases owner's capital. But so when we have an increase in owner's capital, that increase in our revenue would be a credit to capital. Okay. And same thing if we had a net loss. So if expenses were greater than revenues, we would debit our owner's capital for that decrease due to the net loss. Okay, it might be kind of hard to see with these charts and these lines exactly what it's talking about, but when we actually get to the problems, it'll probably make more sense to you. Okay, so if you go back to that chart right here, so anytime it talks about a normal balance for an account, that's whatever increases that account. So for assets, it increases with a debit. So a debit is a normal balance of an asset, all right? Same thing for liabilities. Credits increase liabilities, so liabilities have a normal balance of credit as well as equity, okay? So when we say normal balance, that just means whatever increases that account. So let's look at recording transactions. So when we formally record the transaction, we record it in what we call the general journal. This gives you the flow of what the accounting data does during a transaction. So some kind of transaction occurs. That's the first thing. So we prepare source documents. Anytime we prepare journal entries, we don't just prepare journal entries out of the blue. We have to base it on a transaction, and we need supporting documentation that shows us what the amount is, what it was for, and kind of gives us a sense of what took place in the transaction. Okay, so we analyze the transactions, we determine what two accounts are affected and how we're going to prepare the journal entry. Then we journalize it and we post them. Okay, so we record the transaction, the journal entry in the general journal, and we post it to the T accounts. So this is what we call a journal entry. So we create a journal entry, and we always put the account that's going to be debited first, and then the account that's going to be credited second. Okay, and the account that's going to be credited is actually indented to the right. So let's look at an example. In transaction 1, Bright contributed $30,000 to SmartTouch, and it says cash should be debited for $30,000, and Bright Capital should be credited for $30,000. Oops. So if we were to complete that journal entry, so we would put in the date. So let's assume it is as of today. So the date would be 1/20/15. So we're going to debit cash. So we're going to put cash under the description. It's just whatever the account that is being affected. We're going to debit it for $30,000. All right. And then for the credit for Bright Capital, we would indent it and put Bright Capital and credit it for $30,000. So that's how our journal entry would look, okay? So in transaction 2, it says they purchased land for $20,000 cash, all right? So when we purchase land, that means cash is going to go down, right? So cash is going down. So let's say that this was on the 21st, all right? So cash is going down. To decrease cash is a credit. So it would be under here under credit. Well, we're getting land. Land is an asset. So to increase our assets, we debit it. So we'll do land is our debit. We debit it for $20,000. And our credit is going to be cash. So the most important thing about preparing journal entries is to be able to classify whether things are assets, liabilities, or equity, and what the normal balance is. You have to know those debits and credits to be able to prepare a journal entry, okay? So then in transaction 3, it says they purchased office supplies on account for $500 cash, all right? So when we purchased, it kind of confused you there because it says on account and cash. So let's assume this is the 22nd. I'm not looking. So we're purchasing supplies. Think anytime you're looking at a transaction, let's think about actually what's happening before we start putting anything down. So we're getting supplies, but we're not paying for it yet. Okay. We did spend $500, but it's on account, so that means we hadn't paid for it yet. So we have a liability, and we're getting an asset of supplies. So we're increasing supplies and we're increasing our liability. So now we got to figure out, well, which one's a debit, which one's a credit. Well, assets go up with debits. So we're going to debit our asset of supplies for $500. And then our liabilities increase with a credit. So we're going to do accounts payable as our credit for $500 for those supplies. All right, so now is a good time, if you're looking at this lecture and haven't done it yet, go look at short exercise 2-4 worked exercise video and exercise 2-5. Those are on page 102 of your text, and the videos are in the learning module. All right, so now let's look at learning objective 4, and we're going to prepare the trial balance and illustrate how to use the trial balance to prepare financials. So here's our trial balance. What the trial balance is this is our, at the end of the period, we list total up all of our T accounts and get the ending balances. And those balances are listed here in the trial balance. So this is a list of all of our accounts and their ending balance at the end of the period, okay? So these should be equal to the total of all of the debits should be equal to total credits. So our debits and credits should balance on our trial balance. If it doesn't, then we are missing an account or a balance of one of our accounts is incorrect. Okay, so the whole purpose of this is to list all of the balances and to make sure that our debits and credits equal. Okay, and remember, all of these individual balances come from the T accounts for each of these accounts. If you'll remember from the first chapter, when we prepare the the financial statements, we prepare the income statement first. Everything flows from one statement to the next, so we have to prepare the income statement first. And you'll see that those items, those accounts are grouped together here at the bottom of our trial balance, okay? So they're highlighted in blue, so we can kind of mark the information so we remember that we cannot be used on any other statement. Once we use one account and one balance, it's not going to be used anywhere else on any of the other statements. Okay, so you can check it off once you use it. So we'll use these to prepare our income statement. If you'll remember, we do that with our revenues listed first, less all of our expenses, and that's going to get us net income. Okay, so that's how we're going to calculate our income statement. And remember, our statements have our headings. We've got the name of the company. We identify what the statement we're preparing and for what period that the statement's going to be prepared. Okay, so that's how we prepare the income statement. We'll list our revenues first, list all of our expenses. Revenues less expenses are going to equal net income. If our revenues are greater than expenses, that's net income. If revenues are less than our expenses, that's going to be net loss. And you'll notice that here the expenses are kind of indented over here. This is just so we can summarize and total these items, since we have more than one, to make it clean over here and, you know, no ifs, ands, or buts about it that we're subtracting 5,700 from 16,500. This just makes it easier for the users of the financial statements to better see what we're subtracting, what the totals are. Okay. And also our expenses here, they're going to be listed in descending order. So the largest expense is listed first and the smallest last. All right, so then we use that information from the income statement to calculate our total stockholders statement of owner's equity and what our ending balance is. So this calculation, when we calculate statement of owner's equity, we take beginning capital plus our contributions and net income less withdrawals is going to give us ending capital. So this is where we do that. So we're going to use those next two accounts on our trial balance to do that. And you'll see the heading is the same, and it's for a period of time, so 2 months ended. It's always going to be for a period of time for the income statement and the statement of owner's equity, because we're talking about a period. We're looking at the change in the income over a period of time. All right, so we'll start with beginning capital. So this is our ending capital balance in here. They don't have it in here, but if it had a bright capital balance, this is actually contributions for the period, but we would put that balance here. Anytime we have a balance on the trial balance for like beginning capital, it is not truly the ending balance. Okay, that's just what it was before the period started. So that's our beginning balance. We would put that there. Here we have contributions of 48,000, and then we add in net income. So here's where that kind of flows into the other statement. We have to use that net income from the income statement to plug in here for our statement of owner's equity. That's why we have to do that first. Then we do this, we total up right here our capital plus contributions and income and see what our total is. It's not labeled or anything. The whole reason why we do that is to make sure that we have a balance in our capital account before we take out withdrawals. We can't take money out that we don't have in there. So if this balance was only $4,000, we couldn't take $5,000 in withdrawals, okay? Because then we would have negative capital. But we have 58,800 less our withdrawals of 5,000, and that gives us our ending capital, okay? Now this ending capital is going to flow over to our balance sheet, all right? So the balance sheet mirrors our accounting equations. We got our assets, liabilities, and our equity listed. And this is where we're going to have the balance of all of our accounts listed at. So the date for this statement is going to be as of whatever date we're preparing, okay? So that's for a point in time. So December 31st, 2014. So that, you'll see the rest of all of our accounts are listed, go on the balance sheet. So we'll list all of our assets first, and they're going to be listed in liquidity order. Okay, so the most liquid asset is going to be listed first, and so on. So cash is our most liquid. It's already cash. And when we say liquid, that means we can turn it into cash the quickest. How quick can we turn it into cash? So we'll have cash, and then accounts receivables listed next because we have already claims and rights to the money. We just have to collect it from our customers. So that's why accounts receivables listed next. Then we have office supplies, and then prepaid rent. So prepaid rent is something we paid in advance and we're going to use up over time. So that's next. And then all of our long-term assets are going to be listed next. So these are items that we're going to hold for a really long time. So furniture, like a chair, table in our business, the actual building or the land, these things are harder to actually sell and get cash for really quick. Most of the time we're going to have to list it, find a buyer. So that's why those are listed last. And then we total up our assets. All right. So since this mirrors our accounting equation, we know these total assets should equal the sum of our liabilities and equity. And that's what we list down here. So we'll do the same thing with liabilities. We're going to list our liabilities here, and we'll list them in what we have to pay the soonest. Typically, when you're in the business, you're going to know what's due sooner. But for now, we list it just in accounts payable first, then any individual payable accounts, and we have unearned revenue and notes payable. Now, unearned revenue is cash we've collected from customers, but we haven't done anything to earn it. So we haven't provided them a service or we haven't given them the product. So we owe them something. So that's what unearned revenue is. And those are all shorter term, and notes payable is usually for a longer period of time. And we're going to have to pay interest on it and sign a note. So that's always going to be listed last. That or a mortgage is listed last. Okay, then the bright capital, our owner's equity, the only thing down here is going to be the capital balance that we calculated from that statement of owner's equity. Okay, so that 53,800 goes over here, right here. You will not see anything that goes on the statement of owner's equity in the balance sheet. So contributions, net income, withdrawals, those do not go on the balance sheet. The only thing on the balance sheet we're doing is the balance. The calculation of our capital is done on the statement of owner's equity. Okay, so I don't want to see that on the balance sheet. All right, so now's a good time to go and do practice and look at exercise 2-24 and 25 videos in the module, and also problem 29A on page 112 will be there also. If the video is not there, I'll have the solution for you to do on your own as extra practice. All right, the last learning objective is using the debt ratio to evaluate business performance. So the debt ratio is just going to give us a portion of what we did to get our assets. So what portion did we finance with debt? Typically, if the company's just starting off, you're going to expect this debt ratio to be pretty high. So this is going to be pretty high if they're a new company, and all we're going to do is going to tell us what their ability is to pay its debts. And determine if the company has too much debt to be considered financially healthy. If, like I said, if it's a new company, it's going to be common for this to be high, but if they're a well-established company and this is really high, then it's not going to be healthy. Okay, then it's not a good thing. That's something we would want to look at. So we're going to take our total liabilities divided by total assets, and that's going to give us our debt ratio. And I go over this in exercise 2-9 on page 103, and this video is located in your learning module. All right, so if you have any questions over any of the Chapter 2 material, please post your questions to the Chapter 2 discussion forum in the module. Okay.